Last night, Pitney Bowes, symbol PBI, reported what looks to be a pretty darn good quarter. Now, we've come to expect just such consistency from this company that runs integrated mail and document management systems. That's good news, though, because Pitney Bowes' stock took a nasty hit last fall when people saw the growth slowing, and it hasn't been able to get much traction of late. One of the reasons I like the stock, PBI is one of the most shareholder-friendly companies in existence. In the last 7 years, it's returned an average of 48% of its free cash flow to shareholders, either through dividends or buybacks. And it just boosted its dividend last night. Not many companies are doing that. It has an almost 6% yield. And that's not an accidentally high yield, as the company has always paid out bountiful dividends. Can we expect more good things to come from Pitney Bowes? Let's find out by talking to Murray D. Martin, the chairman and CEO of Pitney Bowes. Mr. Martin, welcome to Mad Money.
Good to see you, Jim.
Sir, can you talk about why your company's philosophy towards shareholders and how you reward them through thick and thin?
Well, we believe that the company is here for our shareholders. It's there for our customers and our shareholders, and we look forward to generating returns for them. And that's why for 27 consecutive years, we have increased our dividend to ensure the return. At the same time, depending on how our cash flows are, we also do stock buybacks to enhance the shareholder value.
Now, some of the analysts believe that the growth is not what it was used to be, and that perhaps it will not return to the old growth, that it's slowing on what's known as a secular basis, that it's just a long-term decline. Is that true?
We don't think so, Jim. We continue to see our EPS growth over the long term in the 10 to 12% range, which is what we have been focused on over time. We did have a little slowdown due to the cyclicality of our lease space. That's the equipment that we lease to our customers, and that has bottomed out and is now moving positive, and we saw that in the fourth quarter.
What kind of organic growth could we get here if the economy just stabilizes?
We have said our organic growth would be in the 2 to 4% range, and that's sort of what we would expect. Now, at the same time, we have diversified our portfolio, and as we continue to diversify and add higher growth areas such as software, marketing services, and mail services, we would expect that to move up in that range over time.
It seems like that people still remember you as just a meter company. Why is it we don't think of Pitney Bowes as more of a technology company?
Well, Pitney Bowes has always been one of the leaders in technology. We are a very large patent holder, and in fact, even during this time, we've continued to increase our spend in R&D, and we are up almost 11% in R&D spend. And so customers don't really realize the technology that is in the metering or postal evidencing devices, but we're expanding that across software. We're a very significant software company today, and also in the mail services area.
Can you talk to me about your exposure to financial services? I don't mean to point out all these negatives. It's just that, to me, people should be buying your stock. But, I get all these different well, the organic growth slowing, the financial service exposure is not good. So why don't you tell us what you're seeing?
Sure. Overall, in the financial service sector, there's about 1/4 of our revenue. However, it is really in the larger ticket items, and we took that hit in 2008. So we think that that is fairly much leveled out at this market rate. The core of our business is much lower than that in a percentage, so we don't see a long-term continuing effect from the basis that we are now at. In fact, I look at it and say a lot of this is large ticket items, it's large software, and all of that will have to renew at a point in time. So I see this as a deferral rather than a loss, because we have not lost any of these revenues.
Excellent. Murray Martin, Chairman and CEO of Pitney Bowes, thank you so much for coming on the show, sir.
Thank you.
You want a company that returns a lot of money to shareholders, just the opposite of what we have come to expect from the banks. You want consistency and a possible, when the economy turns, possible nice move up. Well, then I'll tell you, that's who should buy this stock. If that's your profile, Pitney Bowes is for you. Mad Money's back after the break.